Great. Well, morning everyone. I'd like to extend a warm welcome from beautiful Cape Town. For those that are joining us in person today, we appreciate you taking the time to be here. And for those that are joining us via Spear's YouTube channel, we also appreciate the time you've taken to join this morning. Also, I'd like to extend a warm welcome to some of our board members that have joined us on today's presentation. And we're going to kick off with Spear's interim results presentation for the FY 2026 financial year. I must say that the first half of the year has certainly passed by in a blink of an eye. As I get older, I feel like life is moving at a much faster pace. But often they say that time flies by when you're having fun, and that certainly does resonate with me. I find it a distinct privilege to work with the people that I work with. We find great purpose, joy, and fulfillment in the day-to-day. And as we go from one year to the other, one milestone to the other, we certainly are a very blessed business. Just what we're going to be covering during the course of the presentation today. We'll try not to keep you here too long, but please also do stick around afterwards for some refreshments and for some snacks. One of my favorite books of all time that I come back to often was written by a gentleman called Stephen Covey, 7 Habits of Highly Effective People. And one of the principles that he states in his book is that you should start with the end in mind. And when we look across our business every single year, financial period to financial period, reporting period to reporting period, it really resonates with the mission of Spear. Our mission is to be the leading Western Cape focused REIT, to grow our distribution on an annualized basis, and also to operate within the top quartile of our peer group. Now, the first half of the year has been a very active period for Spear. We have focused on a very robust operational outcomes. We have delivered strong financial cadence for the period, and also we've executed on our growth strategy in line with our plans. However, in 2025 financial year in May, we set out some key strategic objectives for the business. And these 5 objectives, from my perspective, have been very clearly and very succinctly executed during the period. And now these objectives aren't just applicable to FY 26, but they are quite easily replicated across our business from one financial period to the other. The first being portfolio growth and optimization. As a business, we focused on income continuity and acquiring yield-enhancing assets within the Western Cape, in line with our investment strategy. Prudent capital management. We have maintained a disciplined approach to capital allocation, ensuring financial sustainability and stability, and the creation of long-term value for all our stakeholders. We've maintained shareholder alignment. We've upheld material inside ownership, which again reinforces alignment with shareholder interests through transparent stewardship and personal investment of the underlying business. We've developed a sustainable growth strategy, which focuses on strategic asset growth, debt management, human capital development, and our continued rollout of our ESG strategy. And finally, what makes us us is our tenant-centric approach. We continuously look to prioritize strong tenant relationships to support high retention rates and rent preservation. Now, also just for your own edification today, we as a business are a very simplistic business, easy to understand income statement, easy to understand balance sheet, straightforward capital structure. We've also been one of the first early adopters of the new SA REIT BPR. So there are some new acronyms which you'll see coming through in the presentation today. So when we refer to a WALE, it's now the weighted average lease escalation. And when we refer to a WALT, it's the weighted average unexpired lease term. So it's a bit of a tongue twister. So if I do get it mismatched a bit, just please forgive me. With that in mind, we'll move on to the highlights. As announced on SENS this morning, Spear has achieved a 5.21% growth for the interim period in our distributable income per share, as well as our distribution per share. How that translates into the rands and cents, we've achieved a distributable income per share of 43.87 cents for the period, and a distribution per share of 41.59 cents per share. This is based upon a 95% payout ratio. Encouragingly, we have achieved just above the midpoint of our forecast, which was a growth in distributable income per share for FY26 compared to FY25 of 4 to 6%. In terms of our operational performance, we have delivered strong operational performance for the period. We've printed a positive core portfolio rent reversion of 1.31%. We have increased our weighted average lease escalation from 7.27% compared to the prior reporting period to 7.31%. And this is a fantastic compounder of income in our business. When you look at the WALT of just under 30 months, you've got 19% of your portfolio coming up for renewal and relet every year, where the rest is compounding at a 7.31% escalation rate on an annualized basis. And we've seen a marginal uptick in our occupancy rate to 95.05%. However, I'm pleased to say that the leasing team has been doing a lot of heavy lifting lately, and you'll see that occupancy rate improve even further in the second half of the year. Having a look at our growth pipeline, we have still about 300 million rands worth of potential acquisition opportunities we are assessing within this financial year, in addition to a very healthy development pipeline for around 90,000 square meters, which I will talk to a little bit later in the presentation. Also announced on SENS, Spear's done a few acquisitions this year. We've acquired just under 1.08 billion of new acquisitions for the period, 3 new assets, 2 industrial assets and 1 retail asset. These will add around 137,000 square meters of GLA to the portfolio at an average acquisition yield of 9.54%, which is ahead of our cost of capital and is also accretive to the fund from the transfer date. Our balance sheet is primed for growth. Currently probably have the lowest LTV in the sector, but that is by design for the time being. Christian will take you through the LTV sensitivity analysis later on in the presentation to show how that LTV will kind of grow into the more of a 30 percentile LTV later on. Interest cover ratio extremely healthy at 4.05 times. And post the capital raise we did in June, plus the allocation of the new equity for the new acquisitions, we still have around 400 million rands worth of unallocated equity that'll fund additional growth opportunities for Spear. From a PV solar perspective, currently 15 of our assets are installed with PV solar capacity. 11 new assets are under construction, with some having come on stream. Again, Christian will talk to that in the presentation. And our target by the end of FY26 is to have around 12.5 megawatt of generation capacity and growing, because the new acquisitions will also already have their own installed PV capacity. Having a look at the portfolio at a glance, Spear's assets under ownership at the half year was 5.7 billion. We own 39 high-quality assets within the Western Cape. We've seen a portfolio value growth compared to FY25 of 3%, and the GLA very much unchanged at 487,317 square meters. Cost-to-income ratio, we've been doing quite a bit of work on those ratios, 45.61% total cost-to-income ratio, a property cost-to-income ratio of 39.25%, and an admin cost-to-income ratio of 6.39%. The tangible net asset value for the business, 4.8 billion. This is based upon a 12 Rand 10 cents per share. The TNAV did decline slightly as a result of the capital raise, but that was offset a bit by the fair value adjustments that have come through during the half year. As I mentioned, Spear successfully raised 749 million of new equity in June from our shareholders, which we thank you for the ongoing support, which has now resulted in 396 million shares in issue net of treasury. Then having a look at our corporate performance, gross shares in issue, 415 million shares. Now, we view liquidity as a journey, having the benefit of hindsight to see where we started and where we've come, where we are now. It's been incredibly encouraging to see the amount of institutional support coming into the Spear register, irrespective of not yet being included in an index. For the half year, we've traded 371 million rands worth of shares, which is about 9% trade ratio, which includes the new shares that were issued, which is about 37.3 million shares traded for the period. One thing that we've been consistent and in delivering is total return to our shareholders, as well as income returns. Over 5 years, we delivered a 25.9% total return to our shareholders. Over 3 years, 21.3%, and 12 months to end of August, 19%. This is all assuming that you've reinvested your dividend, which we really hope you all have. So having a look at the portfolio overview, I've touched on some of the stats already, so I'll just pick some out which are of importance. I think the average rate per square meter that's passing on the portfolio currently, 123 Rand per square meter on a gross level across 586 tenants. The reversions, we had 1.3% positive on total reversions. On a renewal reversion rate, positive 5.14%. We had 97,567 square meters come up for renewal and relet during the period at a 93% retention rate. Then looking at the development pipeline, so as an income fund, we have to be very mindful of when we develop, how we develop, and how that value is unlocked, given the fact that we are almost allergic to cash drag in our business. So we do have a healthy industrial pipeline of 39,000 square meters, of which the lion's share is in George, and the balance is in Blackheath, and some in Pardon Island. So Blackheath about 7,000, Pardon Island about 2,000. Retail pipeline 8,000 in Pardon Island. The commercial pipeline is also 3,000 in Pardon Island, and residential pipeline is predominantly split between Pardon Island and Sable Square. Then just having a look at the subsectoral breakdown. And I think this is a great way to kind of granularize what's happening in the underlying core portfolio. And we've been incredibly encouraged to see, specifically in the retail portfolio, that more and more retailers are allocating more capex to larger store formats, allocating to new brands, and we've seen it. We're not just the only fund that's seeing this, but it's been evident across some of the retail funds. But from an occupancy perspective, 96.24%. Collections have been very strong at 99%. Reversions, negative 3.81%, which is isolated to 2 vacates that happened at Sable Square and one at Viking Business Park. But I'm pleased to say that the vacate at Viking Business Park has been relet, and that did come off a very long-term lease agreement that we had with one of the banks. Our weighted average lease escalation is at 7.27%. Strong like-for-like NOI growth at 12.69%. And again, as I mentioned, the larger retailers, and just speaking anecdotally at Sable Square, for those that do like the Adidas brand, we've just doubled the size of the Adidas store at Sable Square. They're running some fantastic specials. So if anybody is keen on a deal, please make your way down to Sable Square. It's just down the road, and we do get to share in some of the turnover revenue as well. Then just having a look at the commercial portfolio, I think regardless of whether you're in Cape Town or anywhere in South Africa, the commercial portfolio certainly has been almost a bit of the black sheep of the family. We are very pleased to see how these occupancy rates in our commercial portfolio have consistently ticked up further and further. And it's also about having the right assets in the right locations. And that's what we've seen coming through in the kind of occupancies moving closer and closer back to the 94% in the commercial office space. Collections have been strong at 98.5%, reversion at 10.84%. Again, this is specifically related to 2 leases, one which was a vacancy that was in Tiger Valley, vacant for quite some time, which we relet at a slightly lower rate per square meter, which is what influences your rental reversion, not necessarily the revenue, but it's the rate per square meter that it reverts at. And one was a long-term lease that came off at Northgate, which was in the form of which converted to a sublet, which we then converted to a long-term lease with the company that owns the rights for Birkenstock, Crocs, and Under Armour in South Africa, which we think is a fantastic tenant, and they've increased their footprint with us at Northgate. The weighted average lease expiry at 7.27%, escalation, so, one ping already. Like-for-like NOI growth, 5.7%, with strong letting activity of just under 20,000 square meters during the period, with even stronger letting activity taking place post-period end, with 2 quite stubborn vacancies being let up during the period. Then having a look at the industrial portfolio, always a strong performer across the multi-let, large format, logistics, self-storage segment of the market. Occupancy at 96.49%. That occupancy is also influenced by a sustainability-linked project we are busy with at Mega Park, which probably has about 100 basis point impact on the occupancy, which we do anticipate to bring partially back on stream at the end of Q3 and at the end of Q4, the balance. Reversion positive at 1.55%, collections at just under 100%, and the escalation at 7.47%, which underpins, again, just the compounding growth of that portfolio. The like-for-like NOI growth, -2%, is directly attributed to the 5,200 square meters of space that's currently under a sustainability banner of replacing asbestos with clip lock, because there's a process attributed to that. Removal of the asbestos, you can't have anybody in occupancy. We replace it with a clip lock roof system, and that then follows by an installation of a PV solar system straight after that. So that is the reason, on a like-for-like basis, you'll see that coming through. We've made excellent progress in George. Our perimeter plans are approved. Our SDP is approved for the perimeter. Our SDP is approved for the top structures. Now we await the first plan approval of portion 1, what we call portion 165, which is a 5,000 square meter multi-let industrial unit. And then we're also in the final stages of getting our plans approved for the 7,000 square meter extension of Bravo Park in Blackheath. And I mentioned the sustainability-linked CapEx program. So all in all, from a health perspective, I think we're giving the portfolio, the core portfolio, a very clean bill of health. Then just having a look at the general business update. The operating environment has remained challenging. However, the regional real estate fundamentals have been stronger, and that certainly has underpinned not just the quality of the portfolio, but just the general trading environment. The optimism of the Western Cape has certainly aided the operating business. We do see that the declining interest rate environment, in addition to wage growth, actually contributing to the performance of the portfolio, in particular the retail portfolio. Our debt has remained actively managed, which also has resulted in improved cost of capital, which is making us more and more competitive. That being said, having our investment committee members here, we also are value investors, so we don't just buy anything that moves. We are looking for quality assets in the right locations, despite having a lower cost of capital. All in all, the core portfolio is trading very well. It's achieving all of its operational milestones, despite a couple of headwinds here and there. This is an operating business. You're dealing with people, you're dealing with service providers, but I think the fact that we're fully internally managed, that we can keep our finger on the pulse of operations, collections, and finances, is something that does give us an edge in the market. We've also seen the rising cost of electricity, the potential load shedding risk, and increasing ESG demands will drive us to consistently invest into additional PV solar, additional water augmentation strategies as we execute on our people, planet, profit strategy. Our rent collections have remained robust. As you can see, just under 99% of our rent is being collected. At the end of the day, cash is king, so we need to make sure that that remains at those levels, which again gives us the confidence that we need to maintain our payout ratio at 95%. And then in terms of portfolio enhancements, these are taking place across the portfolio, which again will either unlock future bulk or current embedded bulk, both in the current portfolio, in addition to assets that we've recently announced the acquisitions of. Then just having a quick look at the sectoral split. One thing that we've also been putting a lot of work into was to create a long-term balance between a valuation revenue split in particular. And from a portfolio value perspective, currently 42% of our value is commercial and 39% is industrial. 18% is retail and 1% is development land. From a revenue perspective, it's slightly more balanced. 40% is commercial revenue, 40% is industrial revenue, 17% is retail, and 3% is renewable energy, which we now report within our revenue streams. And then occupancies, you can see how they split, but we'll get into that in a bit more granular detail. Right, so just having a look at the industrial portfolio, just makes it about 2.23 billion of assets across 304,000 square meters. That certainly is the cornerstone of the portfolio at just over 63% of GLA. That generated revenue of 153.3 million for the period and operated at a 96.49% occupancy rate. The assets within the industrial portfolio give us a real good cross-section of the Western Cape industrial market, from logistics to warehousing to mid-size units to urban logistics, which also gives us the benefit of earning rental ranges and being able to supply a solution to tenants that have rental ranges from, call it the 50 Rand a square meter to 120 Rand a square meter for industrial, which we believe does also not niche us in one specific sector of the industrial market. In terms of commercial, 2.4 billion, generated 154 million rands worth of revenue for the period across 127,447 square meters at an occupancy rate of 91%. The one thing about these results, obviously, this is looking in the rearview mirror. Yeah, we know what the look forward looks like, and we can certainly say here, honestly, today that these occupancy rates are slightly better than what they were at the end of the period, which will again contribute to the performance of the balance of FY26. We own assets across the established commercial nodes within Cape Town, which again is also a key part of the investment strategy of the business from a commercial office perspective, is also to own in these nodes, which will underpin rental growth, underpin good occupancy and demand drivers for years to come. The retail portfolio is a portfolio that is growing within the greater Spear portfolio. Assets of just under 1 billion rand. We'll see that with the Maynard acquisition breach over 1.35 to 1.4 billion in the not too distant future. The contribution for this period, 66.4 million rand across 55,560 square meters. That'll also increase to around 84,000 square meters post the acquisition and an occupancy rate of 96.24%. Then having a look at the letting activity for the period, as I mentioned, we had 95,496 square meters come up for renewal and relet during the period. We renewed and relet 95,567 square meters. Now, when one looks at this table, and this is a snapshot of a space in time, but I'd like to draw your attention to the gross rental at expiry columns. We had gross rentals that expired at 7.438 million. We had new rentals at opening rentals at 7.698 million rand. So, from this reversion looks at the rate per square meter, but doesn't take cognizance of the actual revenue. So the revenue is actually higher, despite there being a slight negative reversion print. Then having a look at our tenant and vacancy profile, we've got 586 tenants across the portfolio. 48% of these tenants are considered large national, international tenants, large listed tenants, government and major franchises. 42% national tenants, smaller listed tenants, franchises and medium to large firms. And then 5% would be your typical owner-manager business, entrepreneurial business, and then the vacancy at 4.97%. Across the portfolio, 11,400 of commercial vacancy, 10,600 of industrial vacancy, and 2,000 of retail vacancy. Just to also note, I think there is some sort of a laser here, but I can't find it right now. But as at 30th of September, that vacancy was down to 4.58%. Our lease expiry profile is fairly benign. We have about 19% of our portfolio coming up for renewal and relet on an annualized basis. We have a very clear early engagement strategy. We try and renew and engage with our tenants between 6 and 8 months prior to expiry, if we see that it's going to benefit the business. If it's better to rather push the renewal out or negotiations out to a later stage, if the business will be at advantage, we'll take a strategic decision at that point in time. I'm also pleased to say that in terms of the September 25 to August 26 expiries. Quite a few of those have already been dealt with. And then we do have a large retail expiry from September 26 to August 27, which we're already in negotiations with the operator to extend that lease, and they've indicated their willingness to extend that lease for another 10 years. So all in all, very healthy. So with that said, I'm going to hand over now to Christian Barnard to take us through the financial update. Hold on to your seats. It's got a lot of info. Thanks.
Good morning, everyone. Firstly, apologies for how I sound. I woke up this morning with the most dangerous illness in the world, man flu, so I'll take some Simplies afterwards, but maybe it slows me down. Let's see. So first of all, I'd like to say I am extremely proud of what we achieved in the past 6 months. We met every single target we set out by management and the board set for us. It wasn't always easy, but we met it. There were some strategic decisions, like the vacancy we had to do for the period in terms of replacement of asbestos. It comes with a lot of loss of rent, but still you're carrying the costs, but it was done. And that's obviously a very good kudos to the operational team managing those costs as prudently as they can while there's no income to cover those costs. So then while we look at the detail of the income statement, just firstly, when we speak about like-for-like, just bear in mind, the Mira ex-Mira assets was only acquired in October 2024, so they are not included in the like-for-like numbers. It will only be do so at the end of the financial year. So this is pure the original core portfolio prior to acquisition of those assets. Now, looking at the income statement, our revenue grew by 25.72% because obviously on a normalized basis, those assets are included, but on a like-for-like, it only grew by 4.92%. On an NOI basis, growth of 24.99%, but on a like-for-like was a negative decline of 1.25%. Now, obviously, Quintin and myself obviously both mentioned now, though, there was a 5,000 square meters we technically kept vacant while they are replacing the asbestos. That is a big loss of income, but we still carry all the costs for that areas within the portfolio. So it was budgeted for, we knew it was going to be done, and we are carrying those costs while we're doing all the work, which we anticipate to be completed in a staged process, both in Q3 and Q4 of this financial year, and the income will start flowing back into the portfolio. So we don't have a concern at this point in time, as it was specifically planned to be in that stage. Then looking at our net interest, it declined by just below 7% for the period. That is accumulative factors of lower interest rates, a very low LTV and net debt in the portfolio, and refinancing below our budgets for the period, resulting in the lower net portfolio of debt that we have. Drilling down into the income statement, we also have an interest income ratio of cover ratio of 4.05 times, which is well in excess of our covenant of 2 times. Post the transfer of the 3 assets, which Kim will discuss a bit later, we do anticipate it to be stabilized between 3.6 and 3.8, depending on the timing of the transfers, as most of the assets will be funded with 45% debt, and the balance using our cash reserves, obviously then ultimately from the RCFs, meaning you will actually then pay a bit more interest on those assets. Then looking at our reconciliation, reconciliation for the period, again, I'd just like to point out how simplistic this is. Is it? Hey, move. So, how simplistic this is. There's nothing strange in here. This shows you this is pure proper operating business. The only item that stands out here is the antecedent dividend for the period, which was the result of the capital raise in June 25, which is standard in the REIT practice, adding back those numbers. As Quintin mentioned, distributable income per share for the period generated 43.78 cents per share. Applying a payout ratio of 95% gives a 41.59 cents per share, which will be paid out in June. So watch your bank accounts. I'm certainly happy and ready. Then we will continue with a 95% payout for support of foreseeable future. This is a robust discussion in our board in every single meeting we have. We believe this is prudent as we continuously have upgrades to our portfolio, both on the compliance, income generation, SOLAS activities, which we want to undertake without delving deeper into our debt facilities. Keeping that money back and uplifting the portfolio is, we think, is prudent use of our actual money generated throughout the period. Then, the balance sheet. The balance sheet is as strong as it possibly can be. This was done through a very good capital raise, 5.7 billion in assets, 4.8 billion of tangible net asset value. On the debt side, there is 3 loans that is currently in the current period. The one we're already busy discussing terms to be refinanced by end of February. The other 2 is purely development loans on the Bravo roof replacement and the George facility. So there is no refinance risk on those. It's all under control and will most likely be concluded or extended by coming February for the period. This resulted in an LTV of 13.85%, which is extremely low. But as Quintin mentioned, there's method to the madness. We've acquired 3 very nice assets, which we'll discuss a bit later in the presentation. All of this resulted in a tangible net asset value of 12.10 rand per share. Okay. We'll stop here a bit and discuss a little bit of these items. And the TNAV breach, you will note, we started the period at 12.20 and we ended the interim period at 12.10. Now, the 2 main items that caused the movement in the period was the capital raise that was done in June 2025, resulting in a decrease of 42 cents of the tangible net asset per share. Now, through the very strong performance you just saw in the income statement, the future income in the portfolio, you actually saw the fair value adjustments resulting in a good increase of 27 cents per share. Now, I know sometimes people don't always like to understand what the IFRS smoothing numbers mean. It's accounting adjustments. We accountants supposedly love it. But I mean, if you look at, just going back to the income statement, the smoothing number is a very good indication of what actually happens in your forward-looking revenue for the period. You will see there was a very strong growth in that actual number. Yes, it's an accounting adjustment, but it takes into account your smooth rental for the period until that lease expires. The higher that number grows, it means your income with reversions, escalations, vacancy, everything is growing. That results in good positive fair value adjustments. So even though it's an accounting adjustment, it actually means a lot when you actually dive into what that numbers mean. Why we saw a movement back up to the TNAV. Now, the LTV sensitivity. In this breakdown, we're starting at a 13.85% and growing into a maturity of 30.75 for the LTV to 12 to 24 month period. Now, within these numbers, there's quite a number of transactions that will be concluded in the next period. None of them are specific order, but if you look at the major acquisitions of Berg River, Consani, and Maynard, we actually anticipate Maynard to happen first, then Berg River, then Consani, in that order, even though they're slightly turned around this graph, but there's no change in the actual LTV at the end period. Then we have another couple of properties we are discussing, which we've allocated money towards, but it's not been agreed. But we like to show the market that even if we conclude these transactions purely from cash reserves, what the LTV would be post those transactions. Together, as Quintin mentioned, the Blackheath warehouse we want to build, together with the George build we want to do on portion 165, we've allocated capital towards it. Even though we will not do speculative developments, it will be tenant-driven. But again, we've allocated the capital from our cash reserves to show what the LTV post these transactions. And even after doing that, we still have a LTV below our strategic band of 38 to 43%, meaning we have room to grow. We can go buy. So Kim is busy, believe me. Then speaking of our debt, at the interim period, we had net debt of 1.56 billion of an average all-in cost of 9.02%. Of that debt, 75% is fixed at an all-in cost of 9.08% and an average maturity of 28 months. 25% variable, all-in cost of 8.84%, and an average maturity of 35 months. Now, just again to remind everyone, Spear uses interest rate swaps to fix and hedge our positions in our debt portfolio. The middle pie chart is your net debt of 1.56. On your far right, you then overlay your swaps of 1 billion over that to get to your 75%. So that is what you mean. So it's not you don't have to add those together. The one is showing what swaps overlays the variable in the portfolio. As you will see, we have a robust maturity profile. We don't foresee any refinance risk. We have very capable lenders that provide us very good terms and good times. And during the period, we refinanced 261 million below our budgeted margins, as well as we have 400 million of unallocated cash reserves, which we will be spending in due course. Looking at our covenants, our financial institutions, the covenants are the same across the portfolio, with an LTV of 50% and an interest cover ratio of 2 times. As you can see, we are operating within a massive margin of safety on both these covenants. As discussed previously, we believe the LTV will by year end will be between the 30% margin if all the transactions conclude, then as well as the ICR will most likely decrease between 3.6 and 3.8, still well above our covenant ratios. The graph on the right is just to show you the movement from our previous financial year into the current interim period, what happened to our debt maturity profiles, as well as the cost of debt. I think the only item that stands out there is the marginal increase in our average fixed cost of debt. That was because of our very last COVID swap coming up for refinance, which we did in the period, which caused a very small increase in our overall cost of fixed debt for the period. This is just a very good summary of all the financial results. Some items that Quintin has discussed, some items that I have discussed. I think the one item which there's 3 items in here I just want to highlight. Under the collections and cash is our cash collections of just under 99%. At this point in time last year, we were just above 98%. So we are doing better. Our tenant quality is improving, our tenants are cooperative, paying, the businesses are doing well, so we have very little risk in terms of bad debts and provisions we need to put through the books. Then going to the operating slide at the bottom, you'll see the cost to income ratios. The 45.61 cost to income ratio might seem high, but I want to remind everyone, Spear's interim period coincides with 3 months of winter tariffs at City of Cape Town. Those winter tariffs, you are not allowed to recover from a tenant unless they're on a time of use basis, which very few of them are, but you can recover those costs on a 12-month split basis. I see our utility managers glaring at me like I'm getting information right, but it's not, so it must be right. So we will recover those costs over the 12-month period. So that numbers will decrease. At the comparative period, and this time last year, we were actually at 45.75%, just showing already we're operating at a lower overall cost to income ratio than we were last year. And we believe that number will compress down to 44% towards the end of the financial year. At SA REIT cost to income ratio at 6.39%, we've communicated to the market very clearly at the end of last year, we want to operate between 6 and 6.5%. And the reason for that margin of the band is we are a growing business. As we acquire assets, there will be more staff required, more resources required. So we will continuously need people to run this portfolio together with the executive team. So we will continually operate within that band as we continue to grow this portfolio. But we do believe the number will be between that, and our forecast show will stay between 6 and 6.5 for the financial year. So again, we believe we've met our targets to get it below the 6.5 for the period, and we believe it will stay there looking at the forecast for the period. Now some of the solar information. The solar information, there's a lot of information to try and get into one slide, so we try and do as best as we can. Then just to quickly show our production of solar over the years, just to show how we've grown in terms of our solar journey. At the very end, you'll see the light green there, together with the darker green. That is our estimated production for this current financial year. The dark green being our interim period, and it just shows you the difference between the winter months compared to the summer months. Now, those graphs there does not include the 3 new assets we acquired, which brings on additional 2.4 megawatt of production capacity. Neither does it include, we're currently busy in installation of 11 new assets, of which 6 will reach practical completion of production post-period end by the day we stand here today. None of those factors are included in those numbers. So as it stands on the screen there, we were estimated to produce about 20% more than the prior financial year, which will grow just more as those assets, solar PV assets come online, just generating more free cash flow because the assets we're acquiring, the solar systems are owned by the landlord and fully paid through the acquisition, as well as the new systems we're implementing, we're using our free cash flow resources as we communicated in May to install those systems. So we'll have an expansion of our portfolio. Now we have a 3-pronged approach, which has now moved more to a 1-prong given the IRR. We have roof rentals, finance leases, and self-funded capex. The capex showing IRRs of anything between 15 and 25%, which makes it a no-brainer to use your free cash flow to actually install your solar systems. We will continue to do so to expand our systems wherever we can. If an asset we acquire doesn't have solar, it becomes part of our actual acquisition strategy to see what we can do to install. We also are in advanced discussions in terms of a wheeling between our own assets with the City of Cape Town's framework. It's a bit more complex than we originally anticipated between the various assets, but we believe we have identified the right assets to do so, as well as the selling of carbon credits, which is a very lucrative business, which you sell onto the heavy coal producers of the world, and they buy it from you at no cost to you. And that we believe the income for that will start flowing in the FY27 financial year because it works on a 12-month rolling listed selling cycle. So you can't sell it every year. They have to measure for 12 months, list it, and sell it. So that will only flow in the next financial period. Within this interim period, we generated revenue on solar of 11.2 million and an NOI of 7.3 million. Now, the margin of that is very large, and that's because the majority of the systems we own and we have paid off. The difference in the expenses is the actual cost you pay in terms of those that are still on finance leases or the actual production you pay if it's a roof rental. A roof rental works as someone rents your roof. Whatever is produced, they charge you a fee for that and you on-sell it to the tenant at your normal council applicable rates. Now, that is where your costs sit, but you have a revenue with a slight margin. And then technically, our cost on our roof rentals the cost of the charge actually grows at 7%, but you're allowed to recover at the council tariff. Like this year, if they increase by 14%, your recovery percentage increase by 14%, but your expense by 7%. So you continuously see this divergence on the roof rentals. Now, the roof rental guys have started becoming smarter, but so have we. We started allocating more direct capex rather than doing roof rentals because it's more money for us. So there is a lot of information in our solar, and again, 55% of our total group solar is used by 3 assets, with only a 26% power rate. Mega Park is a heavy manufacturing asset, and that's the attractiveness of that asset. The tenants needs to be there for power. And as Quintin mentioned, as we replace the asbestos, we actually clip on solar to the clip lock, and we continue to use solar income to offset costs of maintenance and capital expenditure on roofs, rather than just diving into the money to offset whatever we have to spend on it. And we will continue to do so. We've successfully done that on Blackheath Park. We replaced 30,000 square meters of roof. We overlaid a 1.2 megawatt solar system on that, and that will generate an IRR of 16% a year to do that. So we will continue to do that. It's money for jam. And that's the end for me. Thank you very much.
Good morning, everyone. Thank you, Christian. Welcome, and thank you for joining us today. I'm going to be taking you through our key progress in terms of our acquisitions, our developments, and finally, our property valuations. I'd like to start by speaking about our 3 key acquisitions, our 3 acquisitions that we have done during this period. Firstly, we have Berg River Business Park in Paarl, Maynard Mall in Wynberg, which I'm sure all of you know and have perhaps even been there, and then Consani Industrial Park, which is in Goodwood/Elsies River. Now, each of these acquisitions represents more than just growth. They are a reaffirmation of Spear's investment philosophy. As you can see, we only invest in the Western Cape. This is a province, or this is a region that we know well and that we believe in. It consistently delivers stable, long-term value. We also stay disciplined and selective, only acquiring assets that strengthen our income base and fit our long-term value investment strategy. We pursue measured growth, with each of these acquisitions exceeding our minimum threshold of 100 million rand. And we pursue meaningful growth, ensuring that every acquisition enhances the quality of our portfolio, and it is certainly not just about growing the fund. Quintin did go through each of these acquisitions in quite a bit of detail in our pre-close, but for those of you that may have missed it, I'm going to just briefly recap on each of them, or each of the salient details. Starting with Berg River Business Park in Paarl. This is a 30,000 square meter light industrial park servicing tenants primarily in the food, wine, and agri-logistics sectors. It is a strategic addition for us, expanding our footprint from our typical Cape Town metropolitan footprint deeper into the winelands, which is a region where we are seeing strong industrial demand and good rental growth. We acquired this asset for just over 182 million rand, and that equates to a rate of around 5,979 rand a square meter. The average gross monthly rental passing at the park is 58 rand. The expected yield from the date of transfer is 9.35%. The weighted average unexpired lease term is a very healthy 5.27 years, and the property is fully let. We anticipate transfer is imminent, is soon, like as in next month. Next, we have Wynberg Mall, or at least Maynard Mall in Wynberg. This is a 455 million rand acquisition. It equates to a rate of around 17,500 rand a square meter. This acquisition strengthens our exposure to high-performing, convenience-based retail with an annualized footfall of 6 million shoppers. This 26,000 square meter community centre, it's also verging on a small regional centre, is anchored by a large ShopRite grocer and complemented by a number of national tenants, many of which you'll know, such as Ackermans, Absa, Clicks, Capitec, Nedbank, Hungry Lion, Pep Stores, Sports Scene, and The Zone Fitness, to name a few. National tenants make up for around 70% of the gross lettable area and 80% of the income, meaning that the vast majority of the income at Maynard Mall is secure. The expected initial yield on this acquisition from the date of transfer is 9.55%. The weighted average unexpired lease term is also very healthy at 4.75 years. Vacancy, less than 1%. This acquisition provides us with access to a well-established urban node with excellent commuter connectivity. It is also perfectly aligned with Spear's retail strategy, which is focused on daily needs convenience and sustainable income growth. Transfer is also expected imminently. I understand it may lodge this week. And finally, we have Consani Industrial Park in Elsie's River. This is an 80,000 square meter multi-let, primarily heavy industrial park, which we acquired for just over 437 million rand at an initial yield of 9.7%. The gross lettable area comprises 42,000 square meters of your typical industrial under roof, with 38,000 square meters of high-yielding yard. This yard area is a great opportunity for us to develop the park further as and when the need may arise, but for now it is high-yielding. If we had to strip out the yard income as well as the associated gross lettable area, the rate per square meter just for the industrial component equates to around 7,500 to 8,000 rand a square meter. Consani also fits seamlessly into our portfolio, being well located in an established industrial node with good connectivity to the N1, the N2, and the R300 corridor. Now, this traditional industrial node in Cape Town typically attracts your larger format industrial user that is heavily reliant on power availability, and that's exactly what Consani does for our tenants. The weighted average unexpired lease term is also very strong at 3.25 years, and the property is virtually fully let with a vacancy of 0.26%. We are currently awaiting Competition Commission approval, and all things being equal, we expect transfer to occur before the end of the year. Now, this slide is admittedly fairly busy, but I'll just break it up for you briefly. The top section with the charcoal grey is essentially a summary of the three acquisitions which have not yet transferred. The green line is where I'd like to draw your attention. So this is what our portfolio is going to look like once these three acquisitions have transferred into the fund. Firstly, the number of properties will increase from 39 to 42. The value of our portfolio will be 6.7 billion rand. And I just want to pause there to show you how well diversified our portfolio will look once the two industrial and retail assets have transferred into our fund. We have always said that we want to maintain an industrial and a retail bias, and this segmentation is looking a lot closer to our ideal segmentation compared to a couple of years ago where 50% of our portfolio was offices. The total gross lettable area will be around 624,000 square meters, and the occupancy will be at a very healthy 96%. Moving on to our developments. On the development front, we continue to create value organically in our portfolio. Firstly, we have GTX Park in George on your right-hand side. As Quintin mentioned, all of our civils and infrastructure works are complete, and we're currently awaiting final approval for our first top structure, which will be 5,000 square meters and multi-tenanted. Once we have received plan approval, we will begin construction, ideally on demand. And this will be the first step to unlocking the full 30,000 square meters of light industrial directly opposite the George Airport. The total development cost, as a recap, will be around 300 million rand, and that's excluding land. And we anticipate this will be over a 3 to 5 year horizon. GTX Park remains a key part of our long-term vision to expand into high-growth regional nodes whilst maintaining our Western Cape focus. Bravo Park Blackheath. Approvals are progressing for our freestanding modern 7,000 square meter warehouse. The design and servicing work are well underway, and construction will commence as soon as we have secured a suitable user. We are currently speaking to 3 potential users, one of which that will take the entire building, and the other 2 would share it more or less 50-50. So at this time, we are assessing those opportunities, and between our management and our leasing team, we will make the right decision for Spear. This project is expected to deliver a very healthy 10% development yield. And as I've mentioned before, this is a great example of how we're utilizing vacant land in our portfolio to drive growth in a capital efficient way. And lastly, but certainly not least, the Anchorage in Pardon Island. Now, this is one of our most exciting mixed-use long-term projects within our portfolio. We have up to 52,000 square meters of available bulk, and the total estimated development cost is around 1.65 billion rand. The Anchorage is a transformative project and one that will redefine Pardon Island from a purely industrial node to a vibrant mixed-use urban node. It will also springboard off and complement Maritime Place, which is the first residential development to go up in Pardon Island, and I'm sure many of you have seen it. It's coming out of the ground very rapidly now as you're driving towards Blouberg on your right-hand side, directly opposite the Cape Town Harbour. Just to go into a little bit more detail on the Anchorage. We have now completed both our feasibility and design phases, and the results are looking very promising for both the commercial and the residential components. And by commercial, I mean 7,000 square meters of retail, which will be a mall with shops fronting inwards as well as outwards towards Marine Place, 2,000 square meters of offices, and 2,000 square meters of light mini industrial units fronting Shropshire Street to the rear of the development. This development will be rolled out in phases, beginning with the commercial components at ground floor, first floor, and mezzanine levels, with a podium there above and 2 retail towers also to be developed in phases. In terms of the residential components, we envisage 632 apartments in total between the 2 towers. The first tower will probably be around 60% of that stock, and the second tower 40%. If you have a look and see the graph above, you will notice that the majority of the apartments will be studios and 1-beds, which is where we're seeing the most demand for Pardon Island. A couple of 2-bedroom apartments, and of course a few penthouses to take advantage of the spectacular ocean views. If you have a look on right next to that, you see there's a parking graph. We will be offering parking of around 971 parking bays. That will be for the entire scheme, but it does differentiate us from Maritime Place, who are 93% sold out with no parking. So we really do believe our offering will be affordable and really well received by the market. Pricing, everyone asks about pricing. The best comparable is Rawson's Maritime Place. Their apartments are between 45 and 65,000 rand a square meter. Ours on average will be between 50 and 55,000, but it really depends on the size of the unit, the aspect, whether it's mountain, ocean facing, and of course the level in the development. Very pleased to announce we have commenced construction on the anchorage. It is the substation and the Unigear room. But what that does mean is that we have now formally entrenched our rights. And I look forward to reporting again in May on our progress on this development. And finally, the property valuations. This is an area of the business that is very close to my heart, being a valuer, or coming from a valuations background. So at the end of August, our total portfolio value increased to 5.6 billion rand. This represents a 2% uplift in value, or roughly 107 million in the 6-month period. If you were here with us in May, you would remember that our valuations were showing around a 5% increase. So over a period of a year, that's approximately 7% growth, and that is something we're very proud of and happy to see that our portfolio is showing the growth. 85% of the portfolio was valued externally now during the interim period, with the balance being reviewed internally. The uplift in our portfolio was largely driven again by our industrial sector and closely followed by the office sector, stable occupancies across our portfolio, and resilience in our rental, or continued rental resilience. There is more detail on each and every valuation available on our website and in our financial booklet, but I'm going to be taking you just through some of the key highlights of our portfolio in totality. The first metric, and one of the most important that I always look for, is the rate per square meter. And that's not just when you're assessing a quality of a portfolio or how it's valued, but it's also very important to us when we buy assets. So looking at our average industrial rate per square meter, it's 7,300 rand a square meter. Offices, that's A grade, at 18,800. Retail at 17,700. Now, for those of you that know and understand rates per square meter within the various sectors, not just in Cape Town or the Western Cape, but also nationally, you will know and understand that our portfolio is very fairly valued, if anything, conservatively valued, given the location, quality of these assets, and that they're all in the Western Cape. Moving on to the average value per property per sector, you will notice that in every sector, we are well above our average or our minimum threshold of 100 million rand, and that just reaffirms the institutional quality of our portfolio. It's also very much in line with one of Spear's key investment philosophies, which means less is more. We prefer to own fewer assets, but assets of higher value. And then the valuation metrics, those are always very interesting to look at, especially if you take a keen interest in discounted cash flows. Average discount rate, exit capitalization rate, market rental growth, expense growth, and your vacancy and void periods, all very much in line with valuation benchmarks across the Western Cape. And it wouldn't be a results presentation for me if I didn't bring up the available bulk in our portfolio. We have currently around 140,000 square meters of available land, or we call it bulk, in our portfolio. And it is important to mention, because this really does differentiate us from many of the other REITs. We do not value bulk at Spear. So the value's there, it's just not reflected in these numbers. And this does represent significant upside in our portfolio as and when we choose to unlock the bulk. Thank you very much for your time. I will now hand back over to Quintin.
Thanks, Christian and Kim. That was excellent. So I'll just take us through the outlook, which is looking very good and a lot of reasons to be optimistic. One of which is that South Africa is set to exit the grey list around the end of October this year, which does definitely bode well for further foreign direct investment, for our debt markets, for our currency, as well as international credibility. And we'll continue to see that flow through into the SA Inc. story, not just the Western Cape story. Looking forward, we will remain laser focused in the execution of our strategy as we continue to deliver on the key performance outcomes for the business. We're a glorified leasing operation, and that's what we're going to stick to. We're sticking to our knitting, and we need to make sure that our buildings remain full and generating positive net cash flows. We are very proud that our active asset management strategy has been implemented and starting to deliver across the portfolio. We've unlocking, call it non-GLA revenue across certain parts of the portfolio, which were not there before, which we will obviously act as a bit of a tailwind. And then again, our portfolio remains very well placed to benefit from the continuous positive shifts in real estate fundamentals within the province, as we obviously see the province of economic hope and opportunity within the Western Cape. But it's also our hope that that can kind of flow upwards to other parts of the country, because I think a national success story is far better than just a provincial success story. And I think and just flowing from the valuations, the growing cash flows within our business does bode very well for valuation growth as we move towards a 7 billion portfolio. The ongoing municipal and provincial infrastructure investment that's taking place, I know that that's been something that the provincial and local authorities have really been holding up as a massive success story. It does provide us with a lot more growth opportunities across the province, which is really positive for our business. And then again, we'll stick to our ESG strategy, executing that on a people, planet, profit approach basis. The interest rate cutting cycle, again, has boded well and will continue to bode well for business and consumers alike. And we do see our retail portfolio as being a net benefactor of that. We'll remain focused on our growth strategy within the Western Cape as we seek out assets that offer long-term sustainable cash flows and growing yields. Our investment bias, as Kim mentioned, will remain towards industrial and retail, the subsectors that we've mentioned already, but also looking at portfolio acquisition opportunities to further enhance the overall quality of the portfolio. And then the development pipeline. The development pipeline is, it's feasibility driven, it's also driven by returns, and also driven by the strength of the balance sheet. And we'll look to unlock those developments and those development pipelines in George, Pardon Island, Blackheath, and Sable Square, which will add additional net asset value growth to each shareholder. The portfolio itself remains in a high quality and desirable nodes, which we believe will continue to unlock good returns for shareholders. And then positively, all things being equal, Spear will be included in the ORPI by March 2026, which again will expand our investor universe. It'll improve liquidity, and I think it's a complement to the business that's been built down here in the Western Cape. Further to this, it's my pleasure to reaffirm our guidance, which was set at between 4% and 6% for FY26. We will maintain a 95% payout ratio. Our guidance is informed and also qualified by a few qualifications. It's not a get-out-of-jail-free card, but these are realities. We live in a binary country where things can go really well or not really well. So we want to just note those. So any changes to those assumptions would certainly impact our guidance. But that brings us to the end of the presentation today. I want to just also take the time to thank you all for attending, for those that attended online. And we're going to be opening up just for a few questions, both online and in person. There'll be a roaming mic that'll flow around here. So yeah, we'll take those questions now. Thank you very much. So is there any questions from the floor? We can maybe start with those while I just quickly get this back to the hero slide. Okay, any questions? Francois, hi.
Yes, hi, thank you. First question from me. You've got Emira acquisition in your books now for pretty much exactly a year. Can you maybe give us a sense of what you found and whether there were any positive or negative surprises? Positives in relation to, for example, ability to sweat assets with solar and bulk that you might develop further, or adjacent properties, etc. And then maybe negatives, any sort of things painted over you've discovered. Maybe just give us a sense of your experience there.
Yeah.
And then second question, you mentioned a 10% expected or internal rate of return. Not sure what that 10% relates to in terms of the Pardon Island arrangement. Maybe if you can just explain that. My understanding is that it's going to be developing existing bulk that's not valued. So the 10% IRR, does that just relate to the commercial properties that you're developing there, or does it, and how does it factor in also the around about 200 million profits you seem to expect from Resi development?
Yeah.
Thank you.
Great, thank you. So on the Emira feedback, as I've said before, the benefit of purchasing from another institution was that the disclosures were excellent. With the acquisition, where we did see some opportunities, were both external and internal kind of asset management opportunities. On the exterior, let's talk about the outside, none of the assets had any PV solar. So of the 13 assets, we have embarked on a installation across 11 of those assets of PV solar, which will generate about 1.5 megawatts of PV solar generation once they're commissioned. As Christian mentioned, 6 out of those 11 are now commissioned and active and starting to contribute towards our solar strategy. I think that was the first thing. Then the second thing is that portfolio was a externally managed portfolio. So all of their renewals, all of their leasing, and everything except their asset management and financial management was done externally. We are a fully internally managed REIT, and what we saw was, if you recall, the average in-force escalation across that portfolio of about 94,000 square meters was about 6.9%. Where the external manager was incentivized to renew leases, but not necessarily to renew the leases across all the kind of KPIs. We see renewal, a successful renewal is growth in expiry, improved escalation, and improved lease term. So our asset management and leasing teams have really been focusing on the expiry rental, the escalation rate, and the average weighted lease term. And we've seen positive inroads across assets, for argument's sake, the studios in Atlas Gardens, we've seen Boundary Terraces, we've seen positive movement at M5 Business Park property, the name now all of a sudden escapes me, Freeway Park. So all in all, it's been really positive. And then in terms of skeletons in the closet, we picked up 1 or 2 anomalies where purchase orders were given on certain items, which were never done. We went back to the counterparty. They were an honourable bunch of people, and they immediately rectified that. And I think that's always the kind of challenge between having an external manager, is there's a bit of a time delay between instruction and execution. And again, that just reinforces our regional approach in terms of being close to our assets, being within 1 hour every one of our assets, and also having it fully internally managed from that perspective. And then we've also, we've seen some opportunities where, 1 or 2 of the assets aren't necessarily aligned with our strategy. We've been inundated with people looking to purchase some of these assets because some of these assets were under 50 million or under 100 million in value. Some of them were like 50 million. But we're very happy and keen to keep the portfolio status quo as it is at the moment. So there's been some very positive leasing, very positive growth in expiries, which again, in escalations, which again has kind of that compounding effect on the income side. So that being said, obviously we wouldn't mind doing another one of those deals. It's been quite beneficial to the business. And then in terms of Pardon Island, so our intention on Pardon Island is once we've got the full feasibility finalized in terms of the full scheme, And maybe just to touch on the reason why we had to start with the high voltage room and the Unigear room is because the rights that were awarded on the during the rezoning were only valid for a 5-year period. And if we did not act on those rights through some form of construction, we would lose those rights indefinitely. And given that risk and the amount of effort and time we put into rezone the property and to achieve those rights, we've commenced on certain aspects of that. Then the intention is to effectively develop the project, sell down in a sectional title scheme style all of the residential units, and to reduce the overall capital cost of the commercial, the retail, and the industrial segment of the development. That's really the kind of plain and simple strategy that we want to take. And the kind of average through rate that we're seeing at the moment that we can probably get it the resi away is around 50 to 52,000 rand a square meter, which includes parking. And already we haven't even launched the scheme. The scheme will be subject to pre-sales. We know development is risky. We've built a business that is credible, predictable, and consistent, and we're not going to bet the farm in order to get this development off the ground. It will be subject to pre-sales, subject to internal approvals, and obviously the banks are already on board to fund the development. But that really is how we aim to achieve that 10% return. We've got really strong interest from retailers. We've done in-depth market studies. The market studies actually point to the fact that we can actually develop over 1,000 rental or residential units and over 11,000 square meters of retail. So deep is the demand in that area for both retail and for residential. So we do believe that, as we kind of launch the development, pre-sales commence, we'll get a quick gauge as to where and how we can push that rate per square meter to further drive the return metrics for us on that development. Any other questions? Christian, anything from?
Lots.
Okay.
Okay.
All right.
Let me stand here next to you. I'm trying to sift through because I think you've answered quite a number in those 12 questions from Francois. More anchor. How many of you are here? With regards to the anchor residential development, you have a pre-sale target of 70% with development to commence if this target is not met. Put differently, is this a hard set target?
Yeah, I think as I mentioned, we're not going to bet the farm on a development. The location of the property, and if I look at the rates of per square meter we're achieving in Pardon Island in some of our other properties, if we don't achieve the required, call it gatekeeper ratios to get the development developed, we will pivot into a more of a redevelopment strategy, uplifting the quality of the assets. Because given the fact of what we've seen at the island, we're achieving 120 rand a square meter on some of our industrial units. So the demand for the area is very, very robust. And as a risk mitigator, that for us is probably going to be the call it the pivot if we don't get the pre-sales. But just given the data and the knowledge that we have at this point in time, we are confident that we'll get the pre-sales.
Okay, another one from Spear share price has re-rated meaningfully over the last few months and is now trading close to all-time high. Do you have more appetite to fund further acquisitions through equity issuance, and is now relatively less dilutive?
Well, I think we all see where the LTV is at the moment and where it's kind of projected to be over the next 12 to 24 months. I think the equity is expensive because you've got to keep on giving your shareholders a return, and it's like feed me more, see more. So we want to obviously be very careful as to how we treat how we treat that equity, because we're quite stingy with the equity. So it all depends on what the opportunity size is. But fortunately, we've also, if you look at the Berg River transaction, we've actually done a deal where the seller is actually taking Spear shares in lieu of cash. So potentially there are those types of deals that'll probably be more akin to us issuing shares at the right price. It all has to kind of make sense at the right pricing, but it's nothing at this stage will cause us to require to raise any equity. Equity is expensive, and right now the LTV doesn't justify the requirement, and we've got 400 million of unallocated facilities that we can also use to further grow the portfolio if opportunities or when opportunities present themselves.
Last one for Anchor. I think I partially answered this, but let me see. Total solar revenue of 11.2 million. Total solar NOI was 7.3 million. Very impressive margin of 65%. How should investors think when trying to reconcile the revenue line and the NOI from solar? So I think by reconcile you mean what makes up the difference. So as I briefly explained, your revenue in terms of is what you're actually allowable to charge and physically what was produced on site. And then your actual expense, obviously deducted from your revenue to get your NOI, is what you are being charged by council or the interest you take if it's finance leases. So we do expect that these will actually grow towards the end of financial year. We believe we can actually beat last year's total revenue by about 20-25%, just depending on how quickly the systems come online. So there is quite a bit of margin within that systems, and we do own the majority of the systems now, and we continue to try and buy out the systems we have options on to make it fully funded systems for our side. Okay, then we have Zinle asked, very small writing, let me get here. Good set of results. You mentioned some challenge encountered in H1. Please add some on what these were and the impact on the specific sectors in the portfolio.
So they weren't sector specific. I think it's more, the SA macro. We had Trump tariffs. We had some uncertainty as to where the interest rate cycle was going. We had a little bit of volatility within the GNU, and these factors coupled together influence tenant behavior. I.e. the influence when they renew their lease, the influence how long they renew their lease for, and obviously these are the kinds of headwinds that we currently face. We also have this impasse with the City of Cape Town in terms of their budget, which also has the potential to impact our kind of revenue and net operating income going forward, because we now have to place more and more pressure on tenants to recover municipal charges, in addition to new municipal charges based upon citywide cleaning and other charges that consistently place tenants under pressure. So there was a bit of an uncertainty as to when and how the city was going to implement that during the beginning of the year, and that was also met with quite a bit of angst from tenants, because tenants are obsessed and concerned about the cost of occupancy. It's no longer just what I'm paying for my square meterage, it's what my total cost is. And we need to find the balance between our objectives as a business and retention of tenants, and obviously facilitating an environment where it's conducive for tenants to renew in a cost of occupancy environment that's sustainable.
So these were from Sisvakila Capital, I see now. You mentioned the focus on innovative letting campaigns across the office portfolio to drive occupancy rates. Can you add some color on that?
Yeah, so for argument's sake, we at the Upper East Side, we had some stubborn vacancies, and we have effectively, those are sectional title units, they're legacy assets. So we've now marketed these to slightly more tech, kind of fintech type of firms, and that was very successful because we secured a 1,500 square meter tenant at the Upper East Side as a result of that campaign. In addition to Northgate, which both of those were slightly more stubborn vacancies. We effectively have, fortunately, not had to go above and beyond in the incentive space, given the fact that there is still quite a constraint in supply, but we've just had to accommodate the tenant with a potentially slightly higher TI as opposed to a extended kind of lease, call it like a sign-on bonus for additional rent-free, etc., etc. So those have been pretty much the kind of incentive, or what's kind of been the innovative campaigns, other than potentially putting Christian on the cover of our vacancy schedule, which would obviously push occupancies to 100%.
We do what we have. The next one is from EPPF. It's a long one. I think this is for me, so I might just quickly read. The like-for-like NOI growth for industrials is -2%, and you have explained that this is largely due to the planned vacancy. If we exclude a planned vacancy, that what we like-for-like NOI growth for industrials be? How long would this vacancy be out of commission for? Is there any other buildings which asbestos, or is this risk completely dealt with this year? Okay, so I think if we just thinking of the numbers, excluding the NOI growth, we most likely would have been on a 1% positive. But bearing in mind, on a like-for-like, Mega Park specifically is the property that actually takes the most strain due to City of Cape Town's tariffs in the winter, where there is exceptionally high time of use tariffs in City of Cape Town, but you recover on a straight line basis. So therefore, it's a very difficult interim period to compare like-for-like with, but towards the end of the year, that will smooth line out. And in terms of the buildings out of commission, in terms of the dealing with this, we have other assets with asbestos, but they are encapsulated and dealt with, and there's no risk that we have to, like this one specifically, where we have to actually vacate to mitigate the risk. So those are dealt with. Just to inform to everyone, you do not have to actually replace asbestos. If it's encapsulated or treated, our COO can give you a very detailed report. He's eager to answer some questions as well. You do not have to replace it unless there's some damage to the asset, or you want to do it as part of your ESG strategy. As long as it's treated, you do your compliance reports every 2 years, then you are within law and you are compliant with what the regulation says.
But we want to add solar to the structure. So that's why we're taking out the asbestos and putting new roofing in.
Okay, Kapana, we should have a presentation just on the Pardon Island.
Yeah.
Okay. In the residential development, what sort of development margins will you achieve?
Yeah, so we're aiming for 20%.
Okay.
That's the margin that we think is the kind of risk, which kind of gives you a commensurate return for the risk that you'll be taking.
Yeah. What scope is there for further developments of this sort in Spear's portfolio?
So as you mentioned, Sable Square, we've got 25,000 square meters of available bulk to be developed. The majority of that would be in the resi space. 2 separate schemes. The first scheme, which if some of you know the centre, there's a big open parking lot that almost looks like a bit of a diamond. 118 units on that scheme, and another 120 units above what is now currently Plastics Mania. We actually can increase the actual envelope or footprint of that site to accommodate another 120 units.
Okay. How do you view Spear's total return composition over the next 3 years, and what steps are you taking to drive the NAV growth per share in real terms?
So I think the growth in NAV is about growing your cash flows, and I think growing the cash flows will grow the property valuations. And I think that we are aiming for a mid-teens to upper teens total return on a consistent basis. I think we've seen kind of real re-ratings coming through. COVID is now behind us, and I think that the sector as a whole is on a much more stable trajectory going forward. So that really is the kind of total returns that we are aiming for. I think that we are now trading possibly at an 8% discount to our net asset value, which we'd love to be trading at net asset value. But I think that's going to probably influence income, how we generate income, how sustainable that income is, how we grow that income, and how we unlock value for shareholders will all kind of be the key drivers to that total return.
2 more from Alistair Anderson, which I believe is the last, what we received. Would you consider acquiring any specialist type businesses, say a resi developer? Does resi offer a future for commercial landlords?
So I think we've done quite a lot of work to narrow the asset exposure for the portfolio into commercial, industrial, and retail. And within those subsectors, we've said in commercial, we're focusing on Century City, the southern suburbs, the northern suburbs, and the Cape Town CBD. Within industrial, we'll focus on Stellenbosch, Paarl, Cape Town, but then obviously that morphs into manufacturing, distribution, urban logistics, large warehousing, and mini units. And then retail, convenience commuter, and convenience retail with some destination retail. So that really is the focus. I think residential development is a bit of a boom-bust environment. So development also comes with having to push your debt up, which is high risk. Things do change quite quickly when it comes to projects in the ground, whether it's residential or non-residential. And for us, we're an income fund, and we want to deliver that kind of sustainable, not pedestrian, but sustainable income growth to our shareholders, which they can see through a profile of lease expiries, through a profile of type of tenants that we have within the portfolio.
Another one from Alistair. Which assets are you looking to sell?
So at this point in time, we have 1 or 2 assets that are, call it strategic potential disposals, but at this stage, there's no real assets that are for sale within our portfolio.
And one snuck in here at the end before we can go eat. The interim results show strong distributed income growth and a 9% payout ratio. Can you unpack how much of the growth is recurring operational performance versus once-off items? 0. We only have recurring operational items. We don't, other than the antecedent dividend, which will only occur on capital raises, we do not account for once-offs, anything that relates in artificially boosting earnings. We are a pure property operating business and will continue to be.
And also, sorry, just in closing, we generated 18 million rands worth of free cash flow after paying everybody, your dividends, your interest, everything. So yeah, well done. Thank you, everyone.